Now, let's look at some tricky situations where IFRS 15 applies differently. First, sale with a right to return. If customers can return items, we only recognize revenue for the expected sales and create a refund liability for expected returns. Example: a company sells products with a 30-day return policy. Based on past data, 5% of products are usually returned. So, the company recognizes revenue for 95% of sales upfront. It also records a refund liability for the expected 5% of returns. At the same time, it records a recovery asset for the goods it expects to get back. This way, revenue reflects what the company actually expects to earn while also accounting for possible returns. Alright, let's talk about the difference between a principal and an agent in revenue recognition under IFRS 15. This is all about who has control over the goods or services before they reach the customer. A company is a principal when it controls the goods or services before they are sold. In this case, the company takes ownership of the goods or services, recognizes the full selling price as revenue. A company is an agent when it simply arranges for another party to provide the goods or services, acting as a middleman. In this case, the company does not control the goods or services, recognizes only the commission or fee as revenue, not the full price. Example: imagine a travel agency selling airline tickets. The agency collects money from customers and passes it to the airline. The agency does not operate the flights, it just arranges the sale. So, the travel agency is an agent and only recognizes its commission as revenue, not the full ticket price. Alright, let's talk about warranties and how they are treated under IFRS 15. When a company sells a product, it may offer a warranty, but not all warranties are treated the same way in accounting. There are two types of warranties we need to consider. Basic, assurance type, warranty. This is the standard warranty included in the product's price. It only guarantees that the product will work as expected for a certain period. Since it's already part of the selling price, it is not a separate performance obligation. The company records a liability for the estimated warranty costs under IAS 37, provisions and liabilities. Extended, service type, warranty. This goes beyond the basic assurance and offers extra services. Examples are additional repairs, maintenance, or protection for an extended period. This is considered a separate performance obligation because the company is providing an additional service. Revenue from this warranty is recognized over time as the service is provided. Example: let's say a company sells a car that comes with a basic warranty, included in the price. This is an assurance type warranty. An optional extended warranty for 3 extra years. This is a service type warranty. How do we account for this? The basic warranty is not a separate performance obligation. The extended warranty is a separate service, so part of the transaction price is allocated to it, and revenue is recognized over the extended period. Next, let's talk about customer options, things like loyalty points, discount vouchers, or renewal options, and how they're treated under IFRS 15. Sometimes, when a company sells a product or service, it also gives customers the option to buy more goods or services in the future at a discount. Under IFRS 15, if this option gives the customer a material right, meaning it's a valuable benefit they wouldn't get otherwise, then it's considered a separate performance obligation. How is revenue recognized? Part of the transaction price must be allocated to this option. Revenue is recognized when the customer uses the option or when it expires. Example 1. A retailer runs a loyalty program where customers earn points every time they shop. These points can be redeemed for discounts on future purchases. Since these points provide a material right, the retailer must treat them as a separate performance obligation. A portion of the sale price is allocated to the points, and revenue is only recognized when the points are used or expire. Example 2. A company sells a 1-year service contract and gives customers the option to renew for another year at a discount. This renewal provides a material right since customers get a special price. So, part of the original transaction price is allocated to this renewal option. Revenue is recognized only if and when the customer renews. Now, let's talk about breakage. This happens when customers don't use all the rights they've paid for, like gift cards, loyalty points, or prepaid services. What is breakage? It's the portion of a customer's rights that is expected to go unused. For example, if customers buy gift cards but never spend the full amount, the company still gets to recognize that revenue over time. How is breakage recognized as revenue? The company doesn't recognize all breakage revenue upfront. Instead, it spreads it out based on how customers use the rest of their benefits. Example: a company sells $1 million worth of gift cards and estimates that 5%, that is, $50,000, won't be used. Here's how revenue is recognized. If customers redeem 60% of their gift cards in the first year, the company can also recognize 60% of the breakage amount. 60% of $50,000 equals $30,000 as revenue in year 1. The rest is recognized as more gift cards are used. Alright, let's talk about non-refundable upfront fees. These are payments that customers make before receiving any goods or services. What are non-refundable upfront fees? These are fees paid at the start of a contract to cover things like setting up an account, initiating a contract, other administrative costs. Even though the company receives the money right away, it can't always recognize it as revenue immediately. How is the revenue recognized? If the fee is linked to a service provided over time, then the revenue is spread out over the contract period. This ensures that revenue is recorded as the company actually delivers value to the customer. Example: a gym charges a $100 upfront fee plus $50 per month for a 1-year membership. The gym can't recognize the $100 upfront fee as revenue immediately. Instead, it spreads the $100 over 12 months because the membership service is ongoing. So, each month, a portion of the upfront fee is recognized as revenue. Next, let's talk about licensing. This is when a company gives a customer the right to use its intellectual property, IP. This can include things like software, trademarks, patents, movies, music, or other media content. But not all licenses are treated the same way under IFRS 15. There are 2 types of licenses, and how we recognize revenue depends on whether the customer gets ongoing benefits or not. First, right to access IP. The customer gets access to a product that evolves over time, like software updates or ongoing support. Revenue is recognized over time because the customer benefits continuously. Second, right to use IP. The customer gets a fixed version of the product at one point in time, like a movie license with no updates. Revenue is recognized immediately when control is transferred. Let's see 2 examples. Example 1. A TV network licenses a movie from a studio for 1 year. The movie is provided as is, and the studio has no further involvement. Since there are no updates or ongoing services, this is a right to use IP. Revenue is recognized immediately when the license is granted. Example 2. A software company licenses its software to a customer and includes ongoing updates and technical support. The customer benefits over time because they keep getting improvements. This is a right to access IP, so revenue is recognized gradually over the contract period. Now, let's talk about repurchase agreements. These are deals where a company sells an asset but has the option, or obligation, to buy it back later. There are 3 types of repurchase agreements. First, forward contract. The company must buy back the asset at a fixed price. Second, call option. The company has the right to buy back the asset but is not obligated. Third, put option. The customer has the right to sell it back to the company at a set price. Depending on the terms of repurchase agreements, forward contracts, and call options can be accounted in 2 ways. Financing arrangement. If the repurchase price is equal to, or more than the original selling price, it's a financing deal, not a sale. Example: a company sells machinery for $50,000 but has an agreement to buy it back for $60,000. The company doesn't record a sale, instead, it recognizes a financial liability. Lease accounting as per IFRS 16. If the repurchase price is lower than the original selling price, the deal is treated as a lease. Example: a company sells machinery for $80,000 but has an option to buy it back for $70,000 within 2 years. Since the company can repurchase it for less, this is accounted for as a lease, not a sale. How to account the put option situations, that is, the customer has the right to sell the asset back to the company. If the repurchase price is higher than the market value, it is treated as a lease because the customer is expected to return the asset. If the repurchase price is lower than the market value, it is treated as a sale with a right of return. Example: a company sells a device for $1,000 with a put option to repurchase it for $950. If the expected market price is above $950, the customer won't use the option, and the company records a sale with a right of return. Key considerations while accounting for options are: always factor in the time value of money when comparing the original selling price and the repurchase price. If the option to repurchase is not exercised, the company can recognize the revenue and remove any liability. Alright, next let's talk about consignment arrangements. This happens when a company sends goods to a retailer but still owns them until they're sold. What is a consignment arrangement? A company, that is, the consignor, delivers goods to another party, the consignee, usually a retailer. But ownership stays with the company until the goods are actually sold to an end customer. Since the company still controls the goods, revenue is not recognized when they are delivered to the consignee. Instead, revenue is only recognized when the consignee sells the goods to the final customer. Example: let's say a furniture manufacturer ships chairs to a retailer under a consignment agreement. The chairs remain the manufacturer's property until the retailer sells them. The manufacturer does not recognize revenue when the chairs are delivered to the retailer. Instead, revenue is only recorded when the retailer sells the chairs to customers. Alright, let's talk about bill and hold arrangements. This happens when a company sells a product but keeps physical possession of it for the customer. What is a bill and hold arrangement? The company bills the customer for the product, but the customer doesn't take delivery immediately. The company stores the product until the customer is ready to receive it. Under IFRS 15, revenue can be recognized before delivery, but only if certain conditions are met. The conditions are: the customer requests the product to be stored. There is a valid reason for the delay, for example, storage issues. The product is clearly identified and set aside for the customer. The product is ready for delivery whenever the customer asks for it. Example: a pharmaceutical company sells a large batch of medication to a hospital. The hospital's storage facility is under renovation, so they ask the company to hold on to the medication for now. The hospital has already paid for the medication and will take delivery once their storage is ready. Since the goods are ready and set aside for the hospital, the pharmaceutical company can recognize revenue even though the medication hasn't been physically delivered yet. Next, let's talk about customer acceptance. This is all about when a company can recognize revenue if a contract requires the customer to formally accept the goods or services. When is revenue recognized? If the contract requires customer acceptance, revenue is not recognized until the customer gives their approval. However, if acceptance is just a formality, revenue can be recognized when control is transferred to the customer. Example: a software company delivers a customized software package to a client. The contract states that the client must test and accept the software before payment is made. The client has 30 days to accept it. However, if the company has met all the contract requirements and past experience shows that clients rarely reject the software, then revenue can be recognized at delivery.